In the shadow of a conflict that has reshaped the geopolitical landscape, a narrative has emerged that challenges the assumptions of Western policymakers. When Russia launched its full-scale invasion of Ukraine in February 2022, leaders in Washington, Brussels, and beyond predicted a swift economic collapse for Moscow under the weight of unprecedented sanctions. The ruble would plummet, industries would grind to a halt, and the Kremlin would be forced to the negotiating table within months. Yet, as we examine the trajectory of Russia's economy through 2025, a different story unfolds, one of unexpected resilience, a wartime economic surge in certain sectors, and a revelation of the limitations inherent in economic warfare. This defiance, far from a mere anomaly, exposes deeper flaws in the Western strategy, raising profound questions about the efficacy of sanctions as a tool of international pressure. To understand this phenomenon, we must begin at the foundations, assuming no prior familiarity with the intricate web of global finance, politics, and trade that underpins it. Let us first establish the context of these sanctions. Sanctions are economic measures imposed by one country or group of countries on another to influence behavior, often without resorting to military action. They can take various forms: freezing assets, banning trade in specific goods, restricting access to financial systems, or capping prices on exports. In the case of Russia, the sanctions were a coordinated response from the United States, the European Union, the United Kingdom, and allies like Japan and Australia. Triggered by the invasion of Ukraine, these measures aimed to isolate Russia economically, deprive it of revenue to fund its military operations, and signal global disapproval of its actions. The initial wave in 2022 included freezing nearly half of Russia's foreign currency reserves, amounting to about $300 billion held in Western banks. This was followed by bans on Russian banks from the SWIFT international payment system, prohibitions on exporting advanced technologies like semiconductors and aircraft parts, and a price cap on Russian oil exports set at $60 per barrel by the G7 nations in December 2022. By 2025, the sanctions had expanded to over 19 packages from the EU alone, targeting individuals, companies, and even third-country entities accused of helping Russia evade restrictions. The goal was clear: to cripple Russia's economy and force a withdrawal from Ukraine. To grasp why this did not unfold as anticipated, we need to delve into Russia's pre-existing economic structure. Russia's economy is classified as an upper-middle-income market economy, heavily reliant on natural resources. Oil and natural gas exports have historically accounted for about 40 to 50% of federal budget revenues and around 15 to 20% of gross domestic product, or GDP, the total value of goods and services produced in a country. Other key sectors include metals, agriculture, and manufacturing, with a significant military-industrial complex inherited from the Soviet era. Before the 2022 invasion, Russia had already faced sanctions following its annexation of Crimea in 2014, which prompted some diversification efforts. For instance, the country reduced its dependence on foreign debt, with foreigners holding only about a quarter of its domestic bonds by 2022. It also built up substantial reserves in its National Wealth Fund, a sovereign wealth fund designed to stabilize the economy during downturns, funded primarily by excess oil revenues. These preparations, though incomplete, provided a buffer against the shock of 2022. The immediate aftermath of the invasion and sanctions was indeed turbulent. In 2022, Russia's GDP contracted by 1.2%, a milder decline than the 8 to 10% drop predicted by many Western economists. The ruble initially fell sharply against the dollar, inflation spiked to over 11%, and imports plummeted due to trade restrictions. However, Russia swiftly implemented countermeasures. The Central Bank of Russia raised interest rates to 20% to stabilize the currency, imposed capital controls to prevent money from fleeing the country, and mandated that exporters convert 80% of their foreign earnings into rubles. These steps halted the ruble's freefall and restored some financial stability. By the end of 2022, the economy had begun to adapt, setting the stage for a rebound. Moving step by step through the subsequent years, 2023 marked the beginning of what some observers have called a wartime boom. Russia's GDP grew by 3.6% that year, surpassing many European economies. This growth was fueled by massive government spending, particularly on the military. Defense expenditures surged to over 6% of GDP, and by 2025 they approached 8% or more, representing nearly 40% of the federal budget. This fiscal stimulus government injection of money into the economy. Through spending included subsidies for defense industries, higher wages for soldiers and factory workers, and payments to families of those killed in action. Such outlays created a multiplier effect, factories ramped up production of tanks, artillery, and munitions, employing more workers who then spent their earnings on consumer goods, boosting retail and services. Unemployment dropped to historic lows of around 2%, as labor shortages emerged from emigration, military mobilization, and an aging population. This tight labor market further drove wage growth, with real wages, adjusted for inflation, rising by about 7 to 8% annually in 2023 and 2024. A critical adaptation was in energy exports, the lifeblood of Russia's economy. The G7 oil price cap aimed to limit Russia's revenues by forcing it to sell oil below market rates to access Western insurance and shipping services. However, Russia circumvented this through a shadow fleet of uninsured tankers, often older vessels registered in non-Western countries, to transport oil to buyers like India and China. By 2025, over 90% of Russia's oil exports bypassed the price cap, sold at discounts but still profitable due to high global prices. Natural gas exports to Europe via pipelines like Nord Stream were severed after explosions in 2022, events still under investigation, but Russia pivoted to liquefied natural gas sales to Asia. While gas revenues fell sharply, oil continued to provide a steady stream, contributing about 15% to GDP even in 2025. This resilience in energy trade prevented the budgetary collapse Western planners had envisioned. In 2024, the momentum continued, with GDP expanding by 4.1%. The wartime economy had fully taken hold, with military-related industries growing by as much as 50% since 2022. Consumer spending boomed, supported by government transfers and low unemployment. Imports recovered through parallel imports, goods rerouted via third countries like Turkey, Kazakhstan, and the United Arab Emirates, often at higher costs but ensuring availability of everything from electronics to car parts. Russia's trade surplus, the excess of exports over imports, remained robust, providing foreign currency to service debts and fund imports. Inflation, while elevated at around 7 to 9%, was managed through interest rate hikes, preventing hyperinflation. This period illustrated how war can paradoxically stimulate economic activity in the short term, much like the industrial booms seen in the United States during World War II, where government contracts spurred manufacturing and employment. By 2025, however, cracks began to appear, tempering the narrative of unbridled defiance. Growth slowed markedly to around 0.6 to 1%, according to forecasts from the International Monetary Fund and World Bank. Inflation persisted at 7.6% on average, down slightly from 9.5% in 2024, but still eroding purchasing power. The central bank raised interest rates to 21% at one point before easing to 16.5%, making borrowing expensive and slowing investment. The budget deficit ballooned due to military spending, with the National Wealth Fund depleted by 59% since the war began. Energy revenues shrank further as sanctions tightened, including U.S. measures on major firms like Rosneft and Lukoil in October 2025, increasing export costs. Consumer spending, once a driver of growth, began to crack under price pressures, with shoppers tightening belts amid higher taxes on corporations, income, and value-added goods. Despite these headwinds, the economy avoided recession, muddling through with domestic bond financing and continued oil sales. Beneath this surface resilience lie hidden or less discussed factors that have enabled Russia's economy to weather the storm longer than expected. One such factor is the role of deathonomics, a term coined to describe the economic incentives tied to military service. In poorer regions, sign-on bonuses for volunteers, often equivalent to several years' wages, and payouts to families of the deceased have injected billions into local economies, reducing poverty in some areas and offsetting social discontent. These payments, while grim in origin, have acted as a form of stimulus supporting consumption in rural and peripheral communities. Another underappreciated element is Russia's pivot to non-Western alliances, particularly through the BRICS group. Brazil, Russia, India, China, and South Africa expanded in 2024 to include Iran, Egypt, Ethiopia, Indonesia, and the United Arab Emirates. This bloc has facilitated de-dollarization, with over 90% of Russia's trade with China and Kazakhstan conducted in national currencies like the ruble and yuan, reducing vulnerability to U.S. financial sanctions. China has become Russia's top trading partner, supplying 90% of critical high-priority imports, including manufactured goods, while Russia exports raw material. As at discounted rates, this asymmetrical relationship, Russia as a junior partner, has enabled sanctions evasion, with Chinese firms often producing goods that mimic Western brands or components. The new development bank, a BRICS institution, has funded infrastructure projects in non-dollar currencies, further insulating Russia from Western financial systems. Sanctions evasion through third countries represents another shadowy layer. Entities in places like Turkey, India, and Central Asia have served as intermediaries, re-exporting banned goods to Russia. For example, advanced microchips essential for military hardware have flowed through these channels, despite export controls. The shadow fleet for oil transport, comprising hundreds of vessels often owned through opaque structures, has allowed Russia to maintain export volumes, albeit at higher insurance and logistical costs. Cryptocurrencies and alternative payment systems have also played a role, though less prominently, in facilitating discrete transactions. Moreover, the sanctions themselves have sometimes backfired, creating unintended boons for Russia. The oil price cap, for instance, has occasionally driven global prices higher due to supply fears, indirectly benefiting Russian revenues. Internal divisions in the West, such as Europe's hesitation to seize frozen Russian assets worth €140 billion due to legal and reputational risks, have limited the sanctions' bite. Germany's and Belgium's opposition to such moves highlights fractures in Allied unity. Additionally, Russia's pre-war reduction in energy dependence and promotion of domestic industries, like nuclear power and aviation, have fostered self-reliance, turning sanctions into a catalyst for import substitution. These adaptations, however, come with costs that are often glossed over. The militarization of the economy has led to a guns versus butter dilemma, where resources poured into defense crowd out civilian investments in healthcare, education, and infrastructure. Labor shortages, exacerbated by the immigration of over 1 million skilled workers since 2022, and military recruitment, project a deficit of 2.4 million workers by 2030. Technological isolation has hindered innovation, with Russia relying on inferior imports from China, potentially locking it into lower productivity growth. The depletion of the National Wealth Fund and rising debt levels signal fiscal vulnerabilities, with experts warning of stagflation, a combination of stagnation and inflation in the coming years. The global implications of Russia's economic defiance extend far beyond its borders, reshaping the architecture of international relations and economics. First, it underscores the limits of sanctions as a standalone policy tool. While they have inflicted cumulative losses, Russia's GDP is estimated to be 12% lower than it might have been without them. The economy has not collapsed, allowing the Kremlin to sustain its military efforts in Ukraine for nearly 4 years. This has prompted a reevaluation among policymakers. Sanctions may slow an adversary but rarely achieve rapid political change without complementary measures like military support for the targeted nation's opponent. Second, Russia's pivot to BRICS in Asia accelerates the shift toward a multipolar world order, challenging Western dominance. The growth of non-dollar trade, BRICS' collective turnover exceeding $1 trillion, promotes de-dollarization, reducing the US dollar's role as the global reserve currency. This could erode America's ability to enforce sanctions unilaterally as more countries seek alternatives to avoid similar pressures. For instance, India's increased purchases of Russian oil at discounts have not only bolstered Russia's revenues, but also stabilized global energy markets, preventing the price spikes that might have harmed developing economies. Third, the sanctions have ripple effects on global supply chains and prices. Restrictions on Russian exports of commodities like wheat, fertilizers, and metals have contributed to food and energy inflation worldwide, exacerbating cost-of-living crises in Europe and beyond. Europe's energy transition away from Russian gas has accelerated renewable investments but at high short-term costs, with some industries relocating due to elevated prices. In the developing world, the fragmentation of global trade, described by the IMF as the disintegration of the world economy into blocs, threatens growth, as smaller nations navigate between Western and Eastern alignments. Furthermore, this episode highlights the double-edged nature of economic interdependence. Russia's integration as the 11th largest economy before the war meant sanctions carried risks for the imposers, including higher oil prices that could boost Russia's earnings paradoxically. It also exposes vulnerabilities in Western unity. While the U.S. has pushed aggressive enforcement, European nations grapple with domestic backlash from economic fallout and inconsistencies under administrations like that of President Trump in 2025 have diluted impact. On a broader scale, Russia's resilience may embolden other nations facing potential sanctions, such as China or Iran, to build similar defenses, stockpiling reserves, diversifying trade, and fostering alliances outside Western spheres. This could lead to a more fragmented global economy, with reduced efficiency and higher costs for all. It also raises ethical questions. Sanctions disproportionately affect ordinary citizens, as seen in Russia's rising poverty in urban areas despite overall stability, while elites often evade them through offshore structures. As we draw this examination to a close, it is essential to reflect thoughtfully on what Russia's economic trajectory reveals about the interplay of power, policy, and persistence. The wartime boom of 2023 and 2024, driven by fiscal might and adaptive ingenuity, did indeed defy the dire predictions of sanctions architects, exposing a failure in Western calculations that underestimated Russia's preparatory measures, resource wealth, and geopolitical alternatives. Yet this defiance is not absolute. The slowdown in 2025, with its inflationary pressures, depleted funds, and structural imbalances, suggests the economy is approaching its limits. Projections for 2026 point to potential recession, banking strains, and deeper consumer woes as the costs of militarization accumulate. The Kremlin may continue to prioritize war over welfare, but at the risk of long-term stagnation, demographic decline, and technological backwardness. This story is not one of triumph or defeat, but of complexity in an interconnected world. Sanctions have reshaped Russia's economy into a fortress, resilient yet isolated, booming in defense yet brittle in civilian life. They have also forced the West to confront the reality that economic tools alone cannot always bend the will of a determined adversary, especially one embedded in alternative global networks. As the conflict in Ukraine persists, the true measure of success will lie not in short-term economic metrics, but in the enduring pursuit of peace, diplomacy, and a reevaluated approach to international coercion. In the end, the defiance of Russia's economy serves as a cautionary tale. In the arena of global affairs, assumptions of quick victory often give way to protracted realities, urging all parties to seek paths beyond escalation toward mutual understanding and resolution. As we approach the end of 2025, the trajectory of Russia's economy offers a clearer picture of the sanctions' long-term effects, one that tempers earlier perceptions of outright defiance with evidence of mounting strain. The wartime stimulus that propelled growth in 2023 and 2024, reaching 4.1% in both years according to revised estimates from Rosstat, has given way to a pronounced slowdown. Preliminary data indicate that GDP expanded by only around 1% in the first half of 2025, with quarterly figures declining progressively: 5.4% year-on-year in the first quarter, 4.1% in the second, 3.1% in the third, and even weaker in the fourth. This deceleration aligns with forecasts from the International Monetary Fund, which projects full-year growth at 0.6% for 2025, followed by a modest 1% in 2026. The World Bank and other institutions echo this outlook, anticipating stagnation or minimal expansion as the economy grapples with overheating, resource constraints, and external pressures. Inflation, a persistent challenge throughout the year, has moderated somewhat but remains elevated. After peaking earlier in 2025, the annual rate fell to 6.6% in November, the lowest since late 2023, driven by slower increases in food, non-food goods, and services. However, core inflation and expectations have edged higher at times, prompting the central bank to maintain high interest rates, cutting the key rate only gradually to 16% by December. These measures, while containing price pressures, have curtailed credit growth and investment in non-military sectors, contributing to the broader cooling. Military spending has continued to dominate fiscal priorities, accounting for approximately 6 to 7% of GDP in official terms, though broader security-related outlays push the figure higher, nearing 40% of total government expenditure. This allocation has sustained employment in defense industries, but at the expense of civilian priorities. Unemployment has remained at historic lows, dipping to 2.1% in mid-2025 before stabilizing around 2.2%, reflecting acute labor shortages rather than robust health across all sectors. Immigration, mobilization, and demographic trends have exacerbated these shortages, forcing wage increases that further fuel inflation while masking underlying inefficiencies, such as part-time work or idle capacity in non-priority industries. Energy exports, long the cornerstone. One of Russia's fiscal stability, faced intensified challenges in 2025. The expansion of the shadow fleet, comprising hundreds of aging, often uninsured vessels, has allowed Russia to maintain crude oil volumes, redirecting sales to Asia amid European import bans. However, sanctions escalated significantly. The United States targeted major producers like Rosneft and Lukoil in October, while the European Union and United Kingdom added dozens of tankers and facilitators to restriction lists. These measures, combined with global oil gluts and depressed prices, Urals crude falling below key budget assumptions, slashed oil and gas revenues dramatically. Reports indicate a 49% year-on-year drop in December 2025, straining the budget and accelerating the drawdown of reserves. The National Wealth Fund, once a substantial buffer, has seen its liquid assets depleted sharply. From pre-war levels equivalent to over 7% of GDP, the accessible portion has dwindled to critically low levels, around 2 to 3% by late 2025, forcing the government to rely increasingly on domestic borrowing. Plans to halt large-scale spending from the fund underscore the shift toward fiscal tightening, with debt issuance projected to rise substantially in the coming years. This depletion not only limits maneuverability for future shocks, but also signals the exhaustion of easy financing options for sustained military efforts. These developments in 2025 reveal hidden vulnerabilities that were less apparent during the initial wartime surge. The economy's adaptation, through parallel imports, third country rerouting, and alliances with non-Western partners, has prolonged resilience but at growing costs. Overheating in defense-driven sectors has led to imbalances. Booming output in munitions contrasts with stagnation or decline in consumer-oriented industries, where higher interest rates and inflation erode demand. Technological dependencies on inferior substitutes from allies like China hinder long-term productivity, while sanctions on advanced components increasingly disrupt even military supply chains despite evasion efforts. Moreover, the human toll manifests in subtle ways. Record low unemployment masks hidden forms of underutilization, reduced hours, forced leaves, or inefficient allocation of labor, particularly outside privileged regions or sectors. Social transfers tied to military service have propped up consumption in some areas, but urban poverty and inequality have risen as inflation outpaces wage growth for many civilians. Demographic pressures, with an aging population and ongoing outflows of skilled workers, project a labor deficit that could reach millions by the end of the decade, constraining potential growth to 1 to 1.5% annually in a best-case scenario. On the global stage, Russia's economic performance in 2025 has amplified debates over sanctions' efficacy and the evolving world order. The relative stability, avoiding collapse despite over 30,000 individual measures, has emboldened narratives in Moscow and among global South nations that Western financial dominance can be challenged. Trade rerouting through BRICS partners, de-dollarization in bilateral settlements, and the shadow fleet's persistence have fragmented global markets, raising costs for enforcement while providing alternatives for sanctioned entities. Yet this has come with trade-offs: higher logistical expenses, discounted sales, and isolation from cutting-edge technologies, positioning Russia increasingly as a resource appendage to economies like China. For the West, 2025 exposed enforcement gaps and coordination challenges. Fractures emerged in sanctioning intensity, with some allies hesitating on aggressive measures amid domestic economic fallout. The partial backfiring, higher global energy volatility in prior years, indirect benefits to non-compliant buyers underscored the complexities of weaponizing interdependence. Nonetheless, cumulative impacts are evident. Russia's GDP trajectory lags far behind pre-war projections, with estimates suggesting a 10 to 15% permanent loss relative to unsubsanctioned paths. This gap translates to foregone investments in infrastructure, health, and education, compounding long-term stagnation risks. Looking ahead, the implications extend to broader geopolitical stability. A constrained Russian economy may limit escalation capacity, but also heighten incentives for risk-taking or asymmetric tactics elsewhere. For developing nations, the episode illustrates both the pains of alignment choices in a polarized world and the potential for resilience through diversification. It reinforces that economic coercion, while powerful, operates on extended timelines, often requiring sustained commitment and adaptation to evasion. In conclusion, Russia's economy in 2025 did not collapse under sanctions, but neither did it truly defy them in a sustainable manner. The wartime boom proved transitory, yielding to structural headwinds that exposed the limits of a militarized growth model. What began as a shock has evolved into chronic pressure, eroding fiscal buffers, distorting resource allocation, and isolating the economy from global innovation. This outcome highlights a partial Western success, not an immediate capitulation, but an imposing enduring costs that constrain ambitions. Yet it also cautions against over-reliance on such tools alone, reminding us that lasting resolutions in conflicts of this scale demand diplomatic engagement alongside economic measures. As the world navigates multipolarity, the lessons from Russia's experience urge a balanced approach, recognizing the boundaries of financial warfare while pursuing paths that prioritize de-escalation and shared prosperity over prolonged confrontation. The story of 2025 is one of adaptation amid adversity, a reminder that economic resilience can prolong stalemates, but at the price of future potential. As we stand on December 25, 2025, reflecting on the year now drawing to a close, the Russian economy presents a picture of pronounced deceleration, one that underscores the cumulative weight of prolonged conflict, elevated military expenditures, and the intensifying effects of international sanctions. Preliminary estimates from Rosstat and international observers indicate that GDP growth for the full year will likely settle around 0.6 to 1%, a sharp contrast to the robust expansions of 2023 and 2024. Quarterly data reveal a clear pattern of weakening momentum. Early in the year, growth hovered near 1.4% year-on-year in the first quarter, before easing to around 1.1% in the second and 0.6% in the third. This trajectory aligns closely with revised forecasts from the International Monetary Fund, which downgraded its projection to 0.6% in October, citing the drag from tight monetary policy, labor constraints, and subdued energy revenues. Inflation, after a period of stubborn elevation, has shown signs of moderation toward year's end. As of mid-December, the annual rate stood at 5.8%, with expectations that it will close the year below 6%, a notable improvement from peaks earlier in 2025. This cooling owes much to the central bank's resolute stance. The key interest rate, which reached highs amid efforts to combat price pressures, was reduced to 16% on December 19 following a series of cautious cuts. Monthly price increases slowed, influenced by factors such as stabilized food and fuel costs, though core measures and inflation expectations remain vigilant concerns for policymakers. The bank's actions have helped anchor expectations, yet the persistence of underlying pressures, stemming from wage growth in priority sectors and fiscal expansion, illustrates the delicate balance required to guide the economy toward the 4% target without precipitating sharper contraction. Military spending has remained a dominant force shaping fiscal dynamics. Allocations under national defense reached approximately 6.3% of GDP, with broader security-related outlays pushing the total closer to 8% in some estimates. Direct war-related expenditures alone accounted for over 5% of GDP, reflecting the prioritization of resources towards sustaining operations in Ukraine. This scale of commitment has underpinned pockets of activity, particularly in defense industries, but it has also amplified fiscal strains. The budget deficit widened, necessitating increased domestic borrowing as alternative financing options narrowed. Unemployment persisted at historically low levels, around 2.1 to 2.2% through much of the year, a figure that highlights severe labor shortages rather than broad-based strength. These shortages, driven by demographic challenges, emigration, and military mobilization, have sustained upward pressure on wages in certain sectors while constraining output elsewhere. The tight labor market has been a double-edged sword. It has supported consumption but exacerbated inflationary tendencies and limited the economy's capacity to expand beyond current bounds. Energy revenues, vital to budgetary stability, experienced significant declines throughout 2025. Oil and gas proceeds fell sharply in the latter months, with November registering a 34% year-on-year drop and December estimated at a 49% decline. Cumulative revenues for the year are projected to be substantially lower than anticipated, influenced by depressed global prices for Urals crude, often trading well below budget assumptions, a stronger ruble reducing ruble-denominated returns, and escalating sanctions enforcement. Measures targeting major producers like Rosneft and Lukoil, alongside restrictions on the shadow fleet and third-country facilitators, have compounded logistical costs and discounts, eroding profitability even as export volumes held relatively steady through rerouting to Asia. The National Wealth Fund, long a critical stabilizer, continued its depletion trajectory. Liquid assets dwindled to levels representing merely 2 to 3% of GDP by late in the year, prompting shifts toward greater reliance on domestic debt markets. This erosion limits the government's room for maneuver in addressing unforeseen shocks or sustaining elevated spending without further fiscal tightening. These year-end developments illuminate several less visible but profound shifts. The wartime model's initial stimulus effects have largely dissipated, revealing structural distortions. Overheated defense sectors juxtaposed against cooling civilian activity, where high borrowing costs and inflationary erosion have curbed investment and demand. Technological dependencies on alternative suppliers, often providing lower quality substitutes, have begun to impede productivity gains. Moreover, the asymmetrical trade relationships with partners in BRICS and beyond, characterized by Russia exporting discounted commodities in exchange for manufactured goods, have entrenched a subordinate position, with limited spillovers to broader economic modernization. Globally, Russia's 2025 performance reinforces the evolving constraints of economic isolation in a fragmented world. The avoidance of outright recession, despite headwinds, demonstrates adaptive mechanisms honed over years of pressure. Yet the slowdown signals that these mechanisms are reaching diminishing returns. For sanctioning nations, the year provided evidence of gradual erosion. Cumulative GDP losses estimated at 10 to 15% relative to pre-war paths, compounded by foregone opportunities in innovation and human capital. Divisions in enforcement, varying intensities across allies, and the challenges of closing evasion loopholes have tempered immediate impacts, but persistent application has steadily narrowed options. Looking forward, projections for 2026 suggest continued modest growth, around 1%, with risks tilted toward stagnation or mild contraction if energy markets remain soft or fiscal adjustments prove insufficient. The interplay of high defense commitments, depleted buffers, and external pressures may necessitate difficult trade-offs: potential cuts in non-military spending, further tax increases, or acceptance of higher inflation. In this reflective moment at the close of 2025, Russia's economic narrative reveals neither collapse nor unyielding strength, but a protracted adjustment to sustained adversity. The defiance observed in earlier years has evolved into endurance under strain, where short-term stability masks accumulating vulnerabilities. Sanctions applied over extended horizons have imposed real and mounting costs, constraining the scope for ambitious state projects while highlighting the perils of over-reliance on resource exports and militarized growth. Ultimately, this chapter reinforces a timeless insight. Economic tools of coercion, when coordinated and patient, can reshape incentives over time, even against resilient adversaries. As global alignments shift and diplomatic overtures emerge, the path ahead will test whether these pressures catalyze change or merely prolong a costly equilibrium, reminding all involved of the imperative for constructive resolution in an era of interdependent yet divided economies.